Something happened in the silver market that deserves far more attention than it has received. At first glance, it looked like another strong trading week, the kind of move many investors have seen before. But beneath the surface, a much more important development quietly unfolded. By the time the market closed for the week, silver had crossed a technical threshold that professional traders, institutional investors, and experienced market analysts have monitored for years. It wasn't simply another upward move in price. It was the type of weekly close that can alter how large investors interpret the entire structure of the market. While most people focused only on the latest price increase, many professionals were studying something far more significant, a signal that often separates temporary rallies from potentially much larger trends. As markets prepare for the next trading session, that signal is likely influencing how major participants position themselves. But as meaningful as it appears, it is still only part of a much larger story. To understand why experienced investors are paying such close attention, you first need to understand what actually changed, why this level matters, and what risks could still cause everything to unravel. One of the biggest mistakes investors make is assuming every price movement carries the same importance. Day after day, silver reacts to headlines, economic reports, geopolitical developments, central bank expectations, and shifts in investor sentiment. Those short-term reactions create constant volatility, making the market appear unpredictable. Prices surge on optimism, fall on fear, then often reverse again before the next trading session begins. Much of this activity is simply noise. It attracts attention, but rarely changes the underlying direction of the market. Every once in a while, however, something different occurs. Instead of responding to temporary emotion, the market itself changes structure. A critical level that has defined investor psychology for years is crossed, and the way professionals interpret future price action begins to shift. These structural changes happen infrequently, yet they often become the moments that shape much larger trends. That's exactly why this latest weekly close is drawing attention inside professional circles, while remaining largely unnoticed by the average investor. To appreciate why this development matters, it's necessary to step back and look at silver's long-term history, rather than focusing only on recent price action. For more than 4 decades, one number dominated nearly every serious discussion about silver. The $50 level became more than just another price target. It evolved into one of the strongest psychological barriers in the precious metals market. Back in 1980, silver surged dramatically before running directly into that ceiling and collapsing. Decades later, during another powerful rally in 2011, history appeared ready to repeat itself. Silver once again climbed toward the same region, touched that familiar resistance, and once again failed to establish itself above it. The market reversed sharply, reinforcing a belief that had become deeply rooted among traders across the world. In many investors' minds, $50 had become the place where silver's biggest advances came to an end. That repeated rejection created an extraordinary amount of historical memory. Every investor who had experienced those previous cycles remembered exactly what happened. Every technical analyst marked the same level on their charts. Every major institution recognized its significance. Over time, that resistance became less about mathematics and more about psychology. It represented decades of failed attempts to permanently move beyond the past. Then everything changed. During 2025, silver accomplished something it had failed to do for over 40 years. Instead of merely reaching that historic ceiling, it decisively broke through it. Even more remarkable, the advance didn't stop there. Momentum continued building until silver eventually climbed above $120, establishing a completely new all-time high earlier this year. Crossing such an important resistance level was historic in itself, but experienced traders understood that breaking through resistance is never the final test. In technical analysis, the true confirmation comes afterward. Whenever an asset escapes a long-standing resistance zone, markets almost always return to test it again. This process is known as a retest. The previous ceiling becomes the area investors expect to act as support. If buyers successfully defend that level during the pullback, confidence in the breakout grows dramatically. If support fails, the entire breakout can quickly be dismissed as another false move. That distinction is critical because genuine long-term trends are often built during these quiet retests rather than during the exciting breakout itself. Over recent months, silver has been going through exactly that process. After reaching its record high above $120, the market experienced a sharp correction. Prices fell aggressively, eventually dropping back toward the $50 region during the spring. The decline was severe enough that many observers immediately concluded the breakout had failed. Critics argued that silver had simply repeated the disappointments of previous decades. Optimism faded rapidly, and many assumed the market had returned to its old pattern. But when the selling pressure reached the former resistance zone, something very different happened. Instead of collapsing below it, silver stabilized. Buyers stepped back into the market. Support held. Rather than continuing lower, silver began rebuilding strength before launching another significant advance. Throughout the latest week, prices climbed back above an important technical area in the low $60 range, finishing the week with a gain approaching 6% and reaching the strongest weekly close since late June. That sequence matters far more than the percentage gain itself. The market approached a critical support zone, survived the test, attracted buyers, and finished the week with renewed strength. For technical analysts, that's far more meaningful than simply watching silver rise. It suggests that the former ceiling may finally be transforming into a lasting floor. If that interpretation proves correct over the coming weeks, then silver is no longer operating inside the same trading range that defined it for generations. Instead, it enters an entirely different phase known throughout financial markets as price discovery. Those two words sound simple, but they carry enormous implications. Whenever an asset spends decades trapped beneath a major resistance level, investors develop expectations based entirely on that historical range. Every previous high creates potential selling pressure because countless participants remember where earlier rallies failed. As prices approach familiar territory, sellers emerge, limiting further advances. History effectively anchors future movement. But once an asset successfully escapes that historical ceiling and continues holding above it, those old reference points begin losing their influence. The market enters unfamiliar territory. There are no decades of trapped investors waiting to sell at previous highs because sustained trading has never existed there before. Without those historical barriers weighing on price action, the market begins searching for a completely new equilibrium. Buyers and sellers gradually establish a fresh understanding of what the asset may actually be worth under current conditions, rather than relying on outdated price history. That search is what professionals refer to as price discovery. For silver, this process carries particular importance because of the way the metal has historically behaved during major breakouts. Unlike much larger financial markets that often trend gradually, silver trades within a relatively small and tightly supplied market. When momentum builds after major structural shifts, price movements have historically become much more aggressive. Previous cycles have demonstrated that once silver escapes significant resistance and genuine price discovery begins, advances can accelerate rapidly rather than unfolding slowly over many years. One example frequently cited by analysts occurred during the powerful rally that culminated in 2011. Once momentum gathered strength during that cycle, silver nearly doubled within only a matter of months. That doesn't guarantee history repeats itself today, but it illustrates why experienced investors treat silver differently from many other commodities. Still, this is exactly where careful analysis becomes essential. Price discovery is often misunderstood. It does not mean prices must immediately continue climbing. It does not eliminate volatility, and it certainly does not guarantee straight-line gains. What it means is something much more specific. The historical ceiling that restricted silver for more than 40 years may no longer be serving as the dominant force limiting future prices. Whether silver ultimately climbs much higher depends on numerous additional factors that extend well beyond technical charts alone. But if this breakout continues holding, one of the market's longest-standing resistance levels may finally have been left behind. Because of that possibility, chart analysts have already begun calculating potential upside objectives using a methodology known as measured moves. Rather than relying on speculation or arbitrary forecasts, this approach estimates future targets based on the size of the decades-long consolidation that preceded the breakout. Applying those calculations produces technical projections near $72 and later around $88 if silver firmly establishes itself within sustained price discovery. These are not promises, and they should never be interpreted as guaranteed destinations. They are simply the next technical objectives many professionals are monitoring if the current structural breakout continues to strengthen. Yet even this remarkable technical development represents only one piece of the overall picture. Another independent indicator, one that many individual investors rarely follow, is now flashing a message that remarkably supports the same bullish narrative. And when those two separate signals begin pointing in the same direction simultaneously, experienced market participants pay very close attention. While the technical breakout has attracted the attention of chart analysts, another indicator has been sending its own message beneath the surface. Unlike price charts, this measure doesn't focus on where silver has traded in the past. Instead, it evaluates silver relative to gold, offering insight into whether one metal appears historically expensive or unusually cheap compared to the other. It is one of the oldest relationships in the precious metals market, and although many retail investors rarely monitor it, institutional traders treat it as an important piece of the bigger picture. This indicator is known as the gold-to-silver ratio. Its calculation is straightforward. Take the current price of gold and divide it by the current price of silver. The result tells you how many ounces of silver are required to equal the value of 1 ounce of gold. On its own, the number means very little. Its importance comes from history. Over decades, the ratio has repeatedly swung between periods when silver became relatively undervalued and periods when it became relatively expensive. Whenever the ratio climbs to unusually high levels, it generally signals that silver has fallen far behind gold. Historically, those moments have often preceded periods when silver begins outperforming. Conversely, when the ratio falls to unusually low levels, silver has typically already experienced much of its strongest advance. At the moment, this ratio has remained in territory that many precious metals analysts consider favorable for silver. In simple terms, compared with gold, silver still appears historically inexpensive. That observation becomes much more meaningful when viewed alongside the technical breakout discussed earlier. The first signal suggested that silver may have escaped one of the strongest resistance levels in its modern history. The second suggests that even after that breakout, silver still has room to close the historical performance gap with gold. Those are two completely different methods of analysis, arriving at remarkably similar conclusions. Understanding why requires looking at how precious metals bull markets have behaved over multiple cycles. Historically, gold tends to move first. During periods of economic uncertainty, financial stress, currency concerns, or expectations of easier monetary policy, investors usually seek safety in gold before they turn their attention towards silver. Gold establishes the initial trend while silver often appears slow and unimpressive. Then something changes. As confidence in the precious metals market grows, investors begin recognizing that silver remains relatively undervalued. Money gradually rotates into silver, and because the silver market is considerably smaller than the gold market, those inflows often produce much larger percentage gains. That pattern has repeated itself during several major precious metals cycles. Gold leads, silver follows, then silver accelerates. One of the clearest examples occurred during the powerful rally that culminated in 2011. Gold delivered an impressive advance, but silver moved dramatically faster, eventually producing gains that substantially exceeded gold's performance. This recurring behavior explains why professional investors monitor the gold-to-silver ratio so closely. When an elevated ratio begins falling, it usually indicates that silver is finally catching up. The adjustment doesn't necessarily require gold to decline. In many cases, both metals continue rising together while silver simply advances at a much faster pace. That is precisely what many analysts are watching today. The ratio is not only elevated enough to suggest silver remains historically inexpensive relative to gold, but it has also approached an important long-term support trend line. Previous cycles have often shown silver beginning its strongest periods of outperformance after the ratio reached similar areas. Once again, this is not a guarantee. Historical relationships never eliminate uncertainty. Markets evolve, economic conditions change, every cycle develops differently. Nevertheless, when a structural breakout and a historically favorable valuation indicator begin reinforcing each other, professionals naturally become more interested. Still, technical indicators alone never tell the complete story. Charts can identify opportunities, ratios can reveal historical relationships, but without fundamental forces supporting those signals, technical patterns often fail. That raises an obvious question. What is happening beneath the surface of the silver market that could actually justify these bullish technical developments? The answer lies in something much more tangible than lines on a chart. It lies in the physical balance between supply and demand. For 6 consecutive years, the global silver market has consumed more silver than the mining industry has produced. That fact alone deserves attention. According to estimates from the Silver Institute, the current year's supply deficit is expected to reach approximately 67 million ounces. In other words, worldwide consumption continues exceeding newly mined production by a significant margin. Temporary shortages occasionally occur in commodity markets. A 6-year deficit is something entirely different. It suggests a structural imbalance rather than a short-term disruption. Demand continues growing while production struggles to keep pace. What makes today's silver market especially unique is the source of that demand. Unlike gold, which is purchased primarily for investment, jewelry, and central bank reserves, silver serves 2 very different roles simultaneously. It functions as a precious metal, but it is also one of the world's most important industrial materials. More than half of global silver demand now comes from industrial applications rather than investment. That distinction fundamentally changes the way the market behaves. One of the largest contributors is the rapidly expanding solar industry. Modern photovoltaic panels depend on silver because of its exceptional electrical conductivity. Each residential solar panel requires roughly 20 grams of silver, and worldwide solar installations continue expanding rapidly. Some industry projections suggest that within the next 3 years, solar manufacturing alone could consume more than 200 million ounces of silver annually. To appreciate the scale of that figure, Consider what it represents. That amount approaches 1/4 of total annual global silver supply, devoted to just one industry. And solar is only part of the equation. Electric vehicles require substantially more silver than traditional gasoline-powered automobiles because of their advanced electrical systems and increased electronic complexity. The accelerating expansion of artificial intelligence has introduced another major source of demand. Building AI infrastructure requires enormous numbers of servers, processors, networking equipment, and high-performance electronics. Massive new data centers continue being constructed around the world, each relying on components that incorporate silver. Then there are the countless additional applications. Fifth-generation telecommunications infrastructure, medical equipment, industrial automation, precision electronics, advanced electrical contacts, high-performance circuit boards. Many of these technologies depend on silver because no other metal performs the same job as effectively. Engineers have repeatedly explored alternatives such as copper or aluminum in an effort to reduce costs. The results have consistently demonstrated lower efficiency, reduced reliability, or inferior electrical performance. That creates an important characteristic economists describe as price-insensitive demand. In many industries, rising prices encourage manufacturers to switch to cheaper substitutes. Silver often doesn't allow that flexibility. When performance matters, manufacturers frequently continue purchasing silver despite higher costs because replacing it simply reduces product quality or efficiency. That makes industrial demand unusually resilient. At the same time, increasing production is far more difficult than many investors assume. If silver prices rise sharply, why don't mining companies simply produce more? The answer lies in how silver is mined. Approximately 70% of global silver production comes as a byproduct of mining other metals such as copper, zinc, lead, and gold. Those mining operations are not primarily searching for silver. Their production decisions depend on entirely different markets. Even if silver prices increase substantially, many mining companies cannot rapidly expand silver output because silver is only a secondary product recovered during the extraction of something else. This creates an unusual situation. Demand continues expanding across multiple industries. Much of that demand remains difficult to replace. Meanwhile, supply cannot respond quickly because most production depends on unrelated mining activity. That imbalance forms the fundamental engine supporting the technical picture. Charts may indicate that the market has opened the door. The physical supply-demand imbalance provides the force that could potentially push prices through it. This is one reason experienced professionals evaluate silver differently than many ordinary stocks. A stock may break above resistance purely because investor sentiment improves. Silver's breakout, however, is occurring alongside a documented physical shortage that has persisted for years. The technical pattern and the underlying fundamentals are reinforcing one another. Even so, responsible analysis requires examining the opposite side of the argument. Every compelling opportunity carries meaningful risks. Ignoring them does not make them disappear. In fact, understanding those risks is often what separates disciplined investors from emotional ones. The first and perhaps most obvious risk is that the breakout could still fail. One strong weekly close is important. It is not definitive. Markets frequently produce convincing breakouts that later reverse. If silver falls back below the reclaimed support area over the coming weeks, the argument that the former ceiling has become a new floor weakens considerably. Confirmation requires time. Anyone claiming the outcome is already certain is overstating the evidence. The second major risk involves the broader macroeconomic environment. Silver's recent strength has been supported in part by expectations that weakening economic data may reduce pressure for additional interest rate increases. Markets responded positively after softer employment data encouraged investors to believe monetary policy could eventually become less restrictive. But expectations can change very quickly. Upcoming releases, including fresh inflation data and the Federal Reserve's meeting minutes, could significantly alter market sentiment. If inflation proves more persistent than expected, policymakers may maintain a more aggressive stance toward interest rates. Higher-for-longer expectations generally strengthen the U.S. dollar and increase bond yields, both of which can create headwinds for precious metals. In other words, the technical setup may remain attractive while the macroeconomic backdrop temporarily moves against it. That possibility cannot be ignored. A third consideration comes directly from shorter-term technical indicators. Following silver's rapid advance from the $50 area into the low 60s, several momentum models suggest the market may have become temporarily stretched. Strong trends rarely move in perfectly straight lines. Even during healthy bull markets, prices often pause, consolidate, or retreat before continuing higher. Such pullbacks serve an important purpose. They remove excessive optimism. They shake out impatient traders. They allow longer-term buyers to establish new positions. If silver revisits previous support before advancing again, that alone would not necessarily invalidate the broader bullish thesis. It could simply represent a normal stage within a larger trend. These risks do not erase the positive signals. They place them into proper context. Professional investors rarely think in absolutes. Instead, they weigh probabilities. On one side of the equation stands a reclaimed 40-year resistance level, a historically favorable gold-to-silver ratio, and a documented multi-year supply deficit supported by expanding industrial demand. On the other side stand macroeconomic uncertainty, potential policy shifts, and the possibility that short-term momentum has advanced too quickly. Both realities exist simultaneously. Recognizing both is what transforms speculation into disciplined market analysis.